Gary, your stock pick, what are you looking at the moment?
Oh, I was going to say Aspen. Looking at my stock pick, I'm going very cautious. As you can see, I'm kind of quite concerned about the geopolitical issues that we're seeing at the moment. It's quite simple. Cash is also a position. So, we've had the US dollar under an enormous amount of pressure over the last year, and we've started to see a blip. We've seen the dollar index starting to move up. Rand dollar exchange rate has sat, kind of around 16, below 16. We've had kind of a technical reversal on that. And I would say after the budget speech, where suddenly your single discretionary allowance has moved from 1 million to 2 million, this might be an opportunity to go and buy some US dollars. So not really a stock pick so much as a cash position. Get that cash ready, because I do think the buying opportunity is coming. I don't think it's quite here yet. I think use that position to pick up some US dollars, park them in an offshore account somewhere, and just wait for a nice entry if markets get truly rattled. If we see the VIX spiking up to sort of 50, 60 and stocks coming off another 10, 15%, those are the dollars you're going to use to go shopping.
Yeah, all this volatility. All right, Graeme, where are you hanging your hat this evening?
I'm going to go for something that's, I suppose, a little out of character, and that's Netflix. Obviously when they were looking at making that acquisition, it was going to change the nature of the beast quite significantly, and would have gone from, being a debt-free, highly cash-generative business. That was a little bit scary, but I think it's a great cash generator. I think the fears of over platforms and the impact on business models like Netflix, I think, are completely overstated. So it's obviously bounced after the news that they're out of the race, but I still think it's a good business model, and having content is a powerful moat.
Yeah. Was that a worry factor, though, for them anyway? I mean, that's a lot of money they were about to go and invest in Discovery Warner Brothers. I think perhaps for them it's a bit of a relief.
Yeah, and I think for shareholders as well, because, as I say, it went from being low capex, high visibility, no debt, strong cash flow, suddenly, the exact opposite. So, if you were a betting person, you might have said, well, the odds were actually going away from where it was very much in their favor just before, Paramount obviously got it. If you were a betting person, you could have taken a position, but it was kind of a binary bet. But now I still think it's a really good business model. And I do think they've got a lot of pricing power. So I agree with you. I think apart from the financials, my sense was, if you put the two businesses together, you would not be able to charge, $15 or $20 simply because you've expanded the content. So there would have been some margin compression there. So I think they're better to not have done the deal, and I think there's a nice break free as well. So happy days all around.
Yeah. Gary, Graeme, thanks to both of you. We do appreciate you taking the time to join us on Stockwatch. Thanks to both of you. And thanks to our guests, Gary Booysen from Rand Swiss and Graeme Körner from the Körner Perspective. That's all for Stockwatch today. Don't forget to tune in tomorrow, the 5th of March at 11 a.m. as we'll be bringing you the live presentation of First Rand's interim results. Up next, the close.